Okay, let's dive in. We're looking at Palo Alto Networks today. Foundational for digital defense, really. But the big question hanging over the stock that's ticker PANW is whether this amazing business growth can possibly justify the valuation. I mean, the market price is, well, it's pretty terrifying right now. Is it an unbreachable fortress built on perfect fundamentals, or maybe just an expensive house of cards? It really is the ultimate conflict, isn't it? And that's what makes digging into this so interesting today. You've got this perfect operational performance bumping right up against some pretty harsh market realities and, frankly, extreme pricing. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, we're deep diving into Palo Alto Networks using our research captured on October 14th, 2025.
Yeah, and before we even get into PANW specifically, we have to look at the market mood. It's rough out there. Pre-market futures are pointing down pretty sharply, actually. The Nasdaq's leading the slide, down over 1% globally.
Oof, yeah. That's a heavy weight for any tech stock to try and swim against.
Definitely. Plus, you've got Fed speakers lined up today, which basically guarantees more volatility, so choppy waters.
Right, but against that backdrop, Palo Alto Networks itself seems to be, well, firing on all cylinders internally. This is the bull case, right?
Exactly.
Just yesterday, BTI upgraded the stock. They put in buy on it. Price target $248.
And that's not an outlier either. The overall analyst view is overwhelmingly positive. You're looking at, over 76% saying buy or strong buy?
So the professional analysts are definitely believers.
They are, and you see investment firms boosting their states too. I think they recognize cybersecurity isn't really optional spending these days, especially when you get that kind of blue chip recognition like PANW just got from IDC. They called them a leader in incident response services.
That IDC recognition is key, isn't it? It sort of solidifies their advantage.
It really does, because it shows they aren't just, selling firewalls anymore. They're selling these institutional sticky services. Think annual recurring revenue, ARR. That's gold.
Okay. So the performance story, the fundamentals, they look perfect. Almost too perfect. But here's where the conversation pivots. The crisis point, that valuation.
Right.
The stock's trading around $213, give or take.
Yeah.
But our discounted cash flow models, they are just screaming caution. I mean, the fair value calculation is way, way lower, somewhere between $42 and $92 a share.
It's a huge disconnect, a staggering one, actually, and it brings up a really important point. Why is the market seemingly ignoring traditional valuation here? See, standard DCF, it often has trouble with these high-growth software as a service companies.
How so?
Well, it penalizes the high upfront investment needed for growth, and it discounts those future recurring revenues pretty heavily. The market, right now anyway, seems to be prioritizing that growth story and the certainty of those sticky contracts. It's pricing PANW for absolute perfection.
Perfection for, the next decade?
Pretty much. Assuming flawless execution, rapid growth, no bumps in the road.
So the argument goes, maybe DCF is just too conservative for this kind of, exceptional mission-critical growth stock.
That's the bull argument for the price, yeah.
But even setting DCF aside, that $213 price leaves absolutely zero room for error, if anything hiccups.
Precisely. And if you look at market sentiment, you see this incredible tug-of-war playing out.
How's that looking?
Well, the options market is leaning heavily bullish, super bullish, actually. The put-to-call ratio is way down at 0.4.
0.4. So explain that for listeners.
Sure. It means for every single options contract betting the stock will fall, there are basically 2.5 contracts betting it's going to rally significantly.
Wow. That's extreme optimism from the fast money crowd.
Definitely. But, and this is the tug-of-war part, that optimism runs smack into some very committed skeptics.
The shorts.
Exactly. The short interest numbers paint a totally different picture. It's sitting at a pretty noticeable 7.24% of the float.
7%?
Yeah.
And how long would it take them to cover?
Based on average volume over 8 days. So these aren't casual bets against the stock. These shorts are dug in. They're banking on a correction.
Okay, so fundamentals great, valuation scary, sentiment totally split. What are the charts telling us? The technicals.
Technically, the long-term trend is undeniably strong. You see that clear staircase pattern, higher highs, higher lows, classic uptrend. And money flow indicators back that up. You see steady, likely institutional accumulation fueling this whole rally over time.
But is there a but? It sounds like there might be.
There is. Lately, that upward thrust, it's definitely losing some steam. Momentum is slowing down.
Right.
It suggests the stock might be, entering a consolidation phase after such a huge run-up. And volatility is ticking higher, too, meaning choppier trading likely ahead.
So putting it all together, Where do we land?
Taking all that evidence, our final verdict is cautiously bullish.
Cautiously bullish, okay.
The company's fundamentals are like a fortress, no doubt. But the risks are significant, and you just can't ignore them. You've got the extreme overvaluation, the negative market mood right now, and that short-term momentum starting to wane.
So the bullish conviction really hinges on company-specific news overriding the broader market worries, like that BTI upgrade.
Exactly. That fresh upgrade is a powerful catalyst working against the negative macro tide. For the bulls, the immediate fight is to push clearly above $215. If they manage that, the target becomes that big options resistance level sitting at the $220 strike price.
Right, that makes sense. And for the bears, or even just for caution, what's the key level to watch?
The critical line in the sand, the invalidation level for the current push, would be a decisive close below $208.
Below $208.
If PANW loses $208, it likely confirms that a deeper consolidation, maybe even a correction, is starting.
So Palo Alto Networks, fantastic company, mission-critical products. Seems like everyone agrees on that. But it's trading at a potentially terrifying price. Priced, as you said, for flawless execution in what is definitely an imperfect world. It just leaves you wondering, can exceptional performance truly justify any price? Or does financial gravity, always pull things back to earth eventually?
A question for you to ponder.
That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.